Here's a question that might make you uncomfortable. If I ask you right now to tell me your exact profit margin, your current ratio, and how many days it takes you to convert a sale into cash in your bank account, could you answer me? If you hesitated even for a second, then you need to watch every second of this video. I'm Tiffany Phillips, CPA and tax strategist, and I help business owners take control of their biggest expense, taxes, so they can build profitable, sustainable businesses with confidence. Here's what I've discovered after working with hundreds of successful business owners. The ones who can answer those questions immediately are the ones building real wealth. The ones who can't are the ones calling me in a panic when they can't make payroll despite having their best sales month ever. And here's what really gets me fired up about this topic. I see so many successful business owners, people making 6 and 7 figures, who have incredible products, amazing customer service, and brilliant marketing strategies. But they're flying blind when it comes to their financial fundamentals. They're making decisions based on gut feelings instead of actual data, and it's costing them thousands, sometimes hundreds of thousands of dollars. The Small Business Administration tells us about half of new businesses fail within the first 5 years. And you know what the number one reason is? It's not bad products. It's not poor marketing. It's financial mismanagement. 9 out of 10 small businesses that fail do so because they didn't understand how money flows through their business. Today, we're going back to basics, but I promise you, even if you think you know this stuff, there are going to be some insights here that will change how you look at business finances and help you keep more of your hard-earned money. Let me start this story that's going to sound familiar to a lot of you. My client, Sarah, owns a thriving consulting business. She was bringing in over $1 million a year, had a waiting list of clients, and from the outside, everything looked perfect. But Sarah called me in a panic one day. Despite all that revenue, she couldn't make payroll. She had no idea where her money was going, and she was about to lose everything because she didn't understand the difference between revenue and cash flow. This is what I call the revenue illusion. Just because money is coming in doesn't mean you're profitable, and just because you're profitable doesn't mean you have cash. These are 3 completely different things, and confusing them is one of the fastest ways to kill a successful business. Here's what most business owners don't realize. There are 5 fundamental transaction types that every single dollar in your business falls into. Revenue, that's what customers pay you. Expenses, that's what it costs to run your business. Assets, that's what you own that has value. Liabilities, that's what you owe to others. And equity, that's your actual ownership stake in the business. Now, I know this sounds basic, but stick with me because here's where it gets interesting from a tax perspective. Most business owners only think about revenue and expenses when they're doing their taxes, but the wealthy, they're thinking about all 5 categories all the time because they understand that each one affects their tax situation differently. For example, when you buy equipment for your business, that's not an expense, that's an asset. And how you handle that asset can save you thousands in taxes through strategies like Section 179 deductions or bonus depreciation. But if you don't understand the difference between an asset and an expense, you're missing out on these opportunities. The real cost of financial literacy isn't just poor decision-making. It's the tax savings you're leaving on the table because you don't understand how your financial transactions actually work. Now let's talk about the 3 financial statements that every business owner needs to understand. Your income statement, your balance sheet, and your cash flow statement. Think of these as the vital signs of your business. Your income statement is like taking your business's temperature. It tells you if you're profitable over a specific period of time. But here's what most people miss. There are 2 ways to look at your income statement: cash basis and accrual basis. Cash basis is simple. You record revenue when you get paid and expenses when you pay them. Accrual basis is when you record revenue when you earn it and expenses when you incur them, regardless of when cash changes hands. Now, here's why this matters for taxes. Most small business owners can choose which method to use, and that choice can have huge implications for your tax bills. If you're using cash basis and you have a big payment coming in January, you might want to delay invoicing until after December 31st to push that income into the next year. That's a simple strategy that can save you thousands. Your balance sheet is like getting a full physical exam for your business. It shows you what you own, what you owe, and what you're actually worth at a specific point in time. This is where you can see if you're building wealth or just staying busy. I had a client who thought he was doing great because his income statement showed solid profits every month. But when we looked at his balance sheet, we discovered he had negative equity. He owed more than he owned. He wasn't building wealth. He was slowly going broke, one profitable month at a time. And then there's your cash flow statement. This is like monitoring your business's blood pressure. It shows you how cash is actually moving through your business. You can be profitable on paper, but still run out of cash if you don't understand cash flow. Here's a real world example. Let's say you're a consultant and you bill a client $50,000 in December, but they don't pay you until February. On your income statement, that revenue shows up in December, but on your cash flow statement, that cash doesn't show up until February. If you're making decisions based only on your income statement, you might think you have money to spend that you don't actually have. Understanding these three statements isn't just about good bookkeeping. It's about making strategic decisions that build wealth and minimize taxes. Let me tell you about something called the operating cycle, because understanding this concept can literally save your business. The operating cycle is the time it takes from when you spend money on your business until you collect cash from your customers. Think about Nike for a minute. They buy raw materials, manufacture shoes, sell them to retailers, and then wait to get paid. From start to finish, that's about 130 days. But they have to pay their suppliers in about 40 days. So for 90 days, Nike has to use cash from other sources to keep operating. Now, if you're McDonald's, your operating cycle is completely different. They buy food, serve it to customers, and get paid in about 2 seconds. They pay their suppliers in 30 days. So for 28 days, McDonald's actually has your cash before they have to pay their bills. That's why McDonald's can grow so fast. Their operating cycle actually generates cash. Most business owners never think about their operating cycle, and it's killing them. They think growth is always good, but if you don't understand your operating cycle, growth can actually bankrupt you. Here's what happens. Let's say you're growing fast and you need to buy more inventory or hire more people to serve new customers. You have to pay for that inventory and those salaries before your new customers pay you. The faster you grow, the more cash you need up front. If you don't have that cash, you're in trouble. I see this all the time with successful businesses. They're growing, they're profitable, and they're constantly stressed about cash flow. They think the solution is to grow faster, but actually, uncontrolled growth is what's causing the problem. From a tax perspective, understanding your operating cycle is crucial because it affects when you recognize income and expenses. If you're on accrual basis accounting, you might show a profit in December, but not collect the cash until March. You'll owe taxes on that profit in April, but you might not have the cash to pay them. This is where strategic tax planning comes in. We can help you structure your business and your operating cycle to optimize both cash flow and tax efficiency. Maybe we set up payment terms that align better with your tax obligations, or we implement strategies that allow you to defer income or accelerate expenses. Here's where we separate the business owners who build wealth from those who just stay busy. It all comes down to understanding the difference between assets and expenses, and more importantly, how to turn expenses into assets. Most business owners think about spending money as either necessary or unnecessary, but wealthy business owners think about spending money as either building assets or just covering expenses. Every dollar you spend is either making you wealthier or just keeping you operational. Let me give you an example. You need a vehicle for your business. You can lease a car for $500 a month. That's an expense. Or you can buy a truck for $30,000. That's an asset. Both get you from point A to point B, but they have completely different impacts on your wealth and your taxes. When you lease, you get a tax deduction for the lease payments, but you're never building equity. When you buy, you might get to deduct the entire purchase price in the first year through Section 179 plus. You own an asset that has value. But here's where it gets really interesting. Let's say you buy that truck and use it 80% for business and 20% for personal use. You can deduct 80% of all the cost, the purchase price, insurance, maintenance, fuel, but you also own an asset that you can sell later. This is the kind of thinking that separates wealth builders from everyone else. They're always asking, how can I turn this expense into an asset? How can I get the tax benefits of spending money while also building wealth? Real estate is another perfect example. You can rent office space, that's an expense, or you can buy a building, that's an asset. With the rental, you get a tax deduction, but you're building something. With the rental, with the purchase, you get depreciation deductions, potential Section 1031 exchanges, and you're building equity. I had a client who was spending $4,000 a month on office rent. Over 10 years, that's almost $500,000 with nothing to show for it. We helped him buy a building instead. Now he's getting the same tax benefits, but he also owns an asset worth over $1 million. The wealthy understand that every business expense is an opportunity to build wealth if you structure it correctly. Now let's talk about something that can completely change how you see your business financial ratios. These are simple calculations that can reveal opportunities and problems that aren't obvious when you just look at your financial statements. One of my favorites is profit margin. You calculate this by dividing your net profit by your revenue. Let's say you made $100,000 in profit on $1 million in sales. That's a 10% profit margin. But here's what's interesting. Profit margin varies wildly by industry. Software companies might have profit margins of 30 or 40%. Restaurants might have profit margins of 3 to 5%. If you don't know what's normal for your industry, you don't know if you're doing well or poorly. I had a client in the construction business who thought he was doing great with a 15% profit margin. But when we compared him to industry standards, we realized he should be closer to 25%. That analysis led us to discover he was underpricing his jobs and overpaying for materials. We fixed both problems and increased his profits by over $200,000 a year. Another crucial ratio is your current ratio. That's your current assets divided by your current liabilities. This tells you if you can pay your bills. A ratio below 1 means you might have trouble meeting your obligations. A ratio above 2 might mean you're not investing your cash effectively. But here's the tax angle that most people miss. These ratios can help you make strategic decisions about timing income and expenses. If your current ratio is too high, maybe it's time to make some equipment purchases to get tax deductions. If it's too low, maybe you need to accelerate some collections or delay some payments. Return on investment is another powerful ratio. This tells you how much money you're making on your investments. But most business owners only think about this for big purchases. The wealthy calculate ROI on everything: marketing spend, employee training, even tax planning services. For example, let's say you spend $10,000 on tax planning and it saves you $30,000 in taxes. That's a 300% ROI in the first year alone. But most business owners see the $10,000 cost and think it's too expensive instead of seeing the $20,000 profit. Let me bring this all together for you, because understanding these financial fundamentals isn't just about being a better business owner. It's about positioning yourself to build real, lasting wealth. Here's what I want you to remember. Every successful business owner I know, every wealth entrepreneur I work with, they all have one thing in common. They understand their numbers. They don't just look at how much money is coming in. They understand how money flows through their business, how to optimize that flow, and how to use that knowledge to minimize taxes and maximize wealth. The difference between business owners who struggle and those who thrive isn't usually the quality of their product or service. It's their financial literacy. It's their ability to make decisions based on data instead of emotions. If this video helped you understand your business finances better, hit that like button and subscribe for more strategies that can help you build wealth and save on taxes. Drop a comment below and let me know which of these financial concepts was most eye-opening for you. I read every comment and often turn them into future video topics. And here's the exciting part. Once you understand these fundamentals, you can start implementing the advanced strategies that really build wealth. You can start thinking about things like tax advantage retirement plans, real estate investments, business structures that minimize taxes, and exit strategies that maximize your wealth. If you want to dive deeper into strategies that could save you 30% or more on your taxes this year, grab my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. You'll learn how to turn your financial knowledge into tax savings, how to structure your business for maximum wealth building, and how to avoid the mistakes that keep most business owners stuck. Don't wait until tax season. Don't wait until you're in a cash flow crisis. The strategies in this book can help you optimize your taxes for this year before it's too late. Make sure you're subscribed because I'm always sharing strategies like this that can help you build wealth and minimize taxes, and you don't want to miss out on what's coming next. Thanks for watching, and remember, keep more of what you earn.